Good evening, everybody. Welcome to the show. Welcome, Kevin. Welcome, Elvina.
Melvin.
Can you guys hear me well?
Yeah.
Yeah, good.
Okay, fantastic. Now, those in the audience who have just joined us, if you can just give us a comment to let us know that you can hear us well. I'll just quickly share my screen. Give me 1 second. Welcome to the show. I hope everyone is home safe. We are on our movement control order, so you should be at home unless you are part of essential services where you need to be out and about. Okay, you can hear us, but there is an echo. Okay, so maybe if you guys don't mind, what I'll do is I might just mute Elvina first. Yeah, okay. Can you guys hear us better? Great. Okay, thank you everyone. Thanks for the comments. Okay, so today, before I get started, very warm welcome to Mr. Kevin Montero. He is the CFO of Japfa Limited, listed on the SGX, and we also have Elvina here. She's dialing in all the way from Indonesia. All right, welcome to the show. Today we're gonna talk about Japfa, what they do, and really what is their business strategy going forward. I think it is a very interesting business to look at. Of course, they are not a small company. Their current market cap is about 2 billion Sing dollars, so that's equivalent to 6 billion ringgit. Now, before I get started, I just want to do a very quick disclaimer. So this webinar is purely for educational purposes. It's not meant to induce you or to suggest for you to buy any shares. Purely getting to know a company, and please, if you are looking for financial advice, please look to your licensed financial advisor. So this is just a casual chat show, and of course this is a session where you get to meet the management as well and also ask them any questions that you guys have. Okay, so all of you who are just tuning in, welcome back. Now, for those of you who have yet to set up an SGX trading account and you're looking for resources, you can actually download the SGX mobile app. That's absolutely free on the Google Play Store or the Apple App Store. Of course, you also have their Telegram channel where they actually send you updates on a daily basis. And of course, if you go to the sgx.com website, you're going to see there's a bunch of resources there that's available to you if you have any questions. There's a lot of resources there, so if you want to read up, it's all there as well. Of course, just a quick shout out to some of the online brokers. For those of you who are looking for an online broker, these are pure online account opening brokers, which is Poems, which is Philip Securities. You can just go to poems.com.sg and find out more. And of course, you also have Tiger Brokers in Singapore. All you need to do is go to tigerbrokers.com.sg. Now, of course, if you prefer to trade with your local broker, they also give you access to the SGX market as well. They are all listed on this link here. As you all know, you can download all these slides later on our WhatsApp bot on 603-8408-2070. Okay, so what I'm going to do is I'm going to unshare my screen and I'm going to get Kevin here to take it away. Show is yours, Kevin.
Thank you, Elvin.
Yeah.
How do I get my presentation onto the screen? Okay, yep. Great.
That's it. Yeah.
Okay, good evening, everybody. Thank you for spending your evening with us, Japfa Limited. I will give you a background of the company. There's a few slides in here, but I won't talk to each slide. I've actually got a stop sharing thing.
Oh, you just hide it.
Yep. Got it. Okay. So we're a industrialized agri-food company. What we do is we produce quality protein staples, dairy products, food. We market to about 3 billion people in our 5 countries that we operate in, which is Indonesia, Vietnam, Myanmar, India, and China. Our head office is in Singapore, and we employ about 40,000 people. Actually, on Monday last week, we celebrated our 50th year since we started the business. That's 50 year. And we actually had a company lunch across the groups where the company provided lunch for everybody, and that was actually 40,000 lunches. So that's kind of putting it in perspective. So we're looking to feed emerging Asia with essential proteins. I think this goes through about the track record about when pre-listing, how we built the business. So the heritage actually comes from Indonesia. And we listed in Singapore in 2014, and today we're in 2021. So very quickly, vertically integrated business. We go upstream, midstream, downstream. Upstream, we produce animal feed and babies. We make babies in our breeding farms. Midstream, we fatten, we milk, and downstream is consumer branded food products that we produce. So we operate in 5 countries, and we do 5 proteins. So in Indonesia, so our business is actually broken down to these 4 major segments you see there. So the first segment we call Animal Protein PT Japfa Tbk Indonesia, and there we do 3 proteins, which is chicken, beef, and aquaculture. Now, we also have an animal protein business in other geographies of Vietnam, Myanmar, and India. And there we've got poultry companies in all 3 countries, and we've also got swine in Vietnam. The downstreaming of animal protein is what we call our branded consumer food, and the 4th segment is a dairy segment. Now, just a quick aside. Essentially, when you look at this, today in emerging economies, most of chickens that we sell, say in Indonesia, is actually through the wet market system. So about 85% of the chickens we produce are actually sold live into the wet market system, which is the main system for distributing food throughout Indonesia. So only 15% would actually go into further processing, whether it's to make raw meat, which is frozen or chilled, or which goes into consumer food products or fast food products. So really, when you look at the demographics of consumption, actually the major part of consumption is really in the live market. And I think that's quite common across all the countries we operate in. Now, the core competencies of Japfa, I think we try to put it in 3 main areas, and that's feed, livestock farming, and branded consumer foods. But the key point is that we are vertically integrated, but also we take an industrialized approach to farming and food production. What does that mean, industrialized approach? It means that when we do a business, we try to go on scale. So we try to do things on scale, and we also try to use the latest technology. So in terms of our business, using genetics is a key, actually. You can give an analogy of our business to trying to build a basketball team, international standard, right? And if I gave you the mandate to build a basketball team that can compete in the US, I mean, the first thing that you need to start off with is babies that have got a 6'5" potential in their DNA, in their genetics. And then you feed them well and you train them how to play basketball. That's how you have a little chance of actually getting an international standard basketball team. It's the same thing with what we do. In terms of our protein business, if we don't start with genetics, you've got no chance to be one of the best performing, high performance protein producers. And after genetics, you got to make sure you complement that with the right feed and look after them with the best management, farm management processes. And that's how you actually build a high performance protein company. On top of that, you need to look after the animal health, because a healthy animal is the one that's actually going to deliver productivity gains for you. And that's how you're going to make money. So you look at biosecurity, which not only protects the animals from a disease, but also makes sure that they are generally healthy. Now, the fourth thing that we call core competencies, or a definition of industrialized approach, is standardization and replication. So we standardize our best practices so that if we wanted to start a poultry business in Myanmar, we don't have to rethink the design of the breeding farm of the for the chickens. We already have had 50 years experience in Indonesia. So what we do is we take a blueprint farm and we replicate it, and that means we can grow very quickly. And that's how we've actually grown our business in many countries. I think growth prospects, you're sitting in Malaysia, you're part of what we call Japfa Emerging Asia. In Asia where the growth is strong. So this graph really says we focus on the 5 countries that have got the most potential for GDP growth, given the past history, as well as a high population where the protein consumption itself could grow, which drives essentially the growth of our business. Now, if you compare Indonesia, for example, where we've got our largest business is chicken. In Indonesia, according to this 2015 thing, Indonesians consume about 10.1 kgs per person per year. Today, it's probably about 11 kgs, maybe affected by COVID, so maybe back to 10. In this graph, in Malaysia, it was 47.5 kgs of chicken. Same Muslim demographic countries, but we consume much less in Indonesia. Why? Because of the GDP per capita in Indonesia being much lower. And in other words, people can't afford to eat chicken. Whereas in Malaysia, you would take chicken as a staple, as the basic protein. When you get your bonus at the end of the year, you can eat more hairy crab or lobster or pisang king. But, really in Indonesia, it is more of a luxury rather than a staple in that way. So the potential for consumption growth in Indonesia obviously is huge. I mean, it's got the chance to grow four times, just as soon as people get the right income levels that allow them to actually spend more money on protein. So really, I think that's the story of our business and where growth comes from. The other thing about our business and about an industrialized approach is that more often you can see that there has been a market shift towards industrialized producers. So in other words, towards producers that are clearly more efficient and clearly have high performance standards, because essentially we are operating in emerging economies. So people need access to some staple basic proteins, and industrialized players more often than not can do it cheaper and with better productivity. So your use of resources is much better. So we've seen in the past, both in China dairy, where we operate dairy farms, there's been a shift from the larger producers, which in 2014 was about 21% of the total production market in China. Today, in 2018, the last time it was measured, it's already 35.7%. And it's the same thing for swine in Vietnam. So in 2014, it was about 15% were made up of industrialized producers. Today, that number has jumped to 40% in 2019. And this is before the impact of African swine fever in Vietnam, where I believe the industrialization or industrialized producers will take an even larger market share in the near term. Okay, so that's basically our business, right? Now, we've been listed about 5 years and 6 years in 2014. And what we did in this section of the presentation is we try to identify our 3 key strategies, and then the actions we've taken in the last 5 years and maybe some results of those actions. So I think the first strategy is industrialized business model, which I've basically been talking about. So the strategic initiatives we put through over the last 5 years was to build an industrialized farming approach, not taking our model in Indonesia and expanding it to different proteins in different countries. So really we use a scientific approach to producing feed, farm design, best practices. We use genetics and replicate that through blueprint. And our achievements or results is that our dairy business in China, where we've got 7 and now building our 8th dairy farm, we have about 90,000 heads of cattle in China. And our yields in China were 34 kg per head per day in 2014. And that's improved to 39.6 kgs of milk per head in 2019. This is on average of our herd, milking herd in China. So that's a huge improvement of yields. And we've consistently improved those yields as well. And our feed business, the second point, our feed business in the animal protein world is actually the stable pillar of profitability for the whole animal protein business. So you have some degree of volatility and fluctuations in terms of day-old chick prices, in terms of broiler prices, because that's largely dependent on demand-supply dynamics. And that can change. It changes with seasons. It changes during Puasa period, where demand goes up, and it drops in particular parts of the year. It changes according to the seasonality of when corn harvests and raw materials are available in Indonesia. So all that changes the dynamics of the day-old chick and the broiler business. But what keeps everything stable in terms of our animal protein profitability is actually the feed business, because feed, we actually are able to pass on. So feed is based on a cost-plus methodology. You make a small margin, but you are consistently able to pass on all raw material cost increases into your feed selling price. And those cost increases could come from changes in commodity prices for those imported feed raw materials, or even depreciation of a currency like rupiah. So our basic business is actually feed. It's about 50% of the sales or of the animal protein business, whether it is chicken, pork, swine business. It's all our aquaculture is all primarily a feed business, and that's a key business and a key business measure to the success of our business and its growth. So over the last 5-6 years, we've grown from 3.6 million tons of feed produced by Japfa Ltd across all the countries to 5 million tons in 2019, which is an increase of about 1.4 million tons in the last 5 years. So that's hopefully building of a pillar of profitability. And then the third thing, our strategic initiative to replicate our business model. I think in Vietnam, we've seen revenues grow from 320 million to 445 million in the 5 years. We've seen our aquaculture feed grow in volumes by 40% almost, and revenue growing by almost 40% as well. And our beef operations in China, which was struggling for a while, has improved productivity and profitability turned around in 2019. And today we're making a lot of money in China on beef. The other strategic initiatives was to expand downstream with food traceability. So we've built more dairy farms in China, in Indonesia, a second dairy farm. So our Greenfields brand is consistently the #1 pasteurized fresh milk category in Indonesia. You see the volumes of milk increased by 60% over the last few years, and another testimony to our branding or consumer branded strategies. After six months of introducing stirred yogurt as a new category for Greenfields in 2018, the brand itself brought it to #1 stirred yogurt brand after just 6 months on the market. So we have a strong brand as a premium brand in Indonesia. Now, the other things is in our industrialized farming mentality, and I talked about biosecurity, we are very stringent and strong on our biosecurity, and we have a strong experience, a big group of people that have an attention to detail to make sure that we apply stringent biosecurity protocols. And how does that, that's a strategy. It's all very good when things are rolling along normally. You can measure your mortality, you can measure your performance in the farms, right, with biosecurity. But I think when big things happen, and like African swine fever affected swine across China, across Vietnam, our business in Vietnam, I think through our industrialized mentality, we were able to minimize the impact of African swine fever on our business. And what does that mean? That means after the African swine fever decimated maybe 40% of the swine population in Vietnam, of course, there's more demand than supply. And of course, the pork prices have increased through the roof in 2020. And by us actually having an industrialized mentality and minimizing the impact on our swine herd, we have been able to capitalize on the rebound of the swine fattening prices in 2019 and the whole of 2020. And finally, I think in terms of breeding business as well, we tend to take breeding very seriously. In my analogy of building a basketball team, if you don't start with the 6'5" genetic kids, there's no chance you're going to build an international basketball team if you just take random genetics. So that's how we think about our business. And I think where we've seen it is actually, again, in Vietnam, where I think by actually having a breeding program that starts from great-grandparent level to grandparent to parent level, then to final stock. When there's a disease outbreak that affects the swine population, I think we can replenish our own breeding farms much faster and actually, again, take advantage of the strong swine prices. These are some market positions. So I think in terms of Indonesia, we are the second largest feed producer and the second largest day-old chick production. Together with the largest producer, we have more than 50% of the feed market in Indonesia and more than 60% of the day-old chick market. In Vietnam, we are #2 in day-old chick. In Myanmar, we are #2 in day-old chick as well, but #1, I think, in feed. Our industrialized business model, I think I've spoken to this, we've built our feed business quite well. And you can see the rate of growth of our swine feed in Vietnam, 6%, poultry feed in animal protein other, about 11%, and PT Japfa TBK poultry feed about 5% over the 5-6 years. So pretty strong growth. And this is our dairy business in China. So our dairy business in China, you can see yields, as I said earlier, increased from 34.2 to 39.6. It's incremental, but it's very hard to increase yields. I mean, it's basically getting a higher productivity from your cattle each year. And that's not an easy thing to do because you have to just keep improving and pushing changes. It might be minute changes to the operations, but over time, they actually have an impact on the whole herd being able to deliver, a higher yield. So what does 39.6 yield per cow mean? You go to 39.6 kgs is basically 1 kg is equivalent to 1 liter. And if you go to the supermarket and you buy 1 liter carton, right, of milk, you roughly know what that means, right? So basically, each of our cows produce 40 liters every day. So essentially, that's to give you a sense of what it means to have a yield increase from 34 to 39.6. At the same time, our dairy herd has been increasing as well, from 2014 to 2017, and kind of flattened out for the other 3 years. Now, in our swine business, I think I said to you that our strong farm management has been able to minimize the adverse effects of African swine fever, and allowing us to rebound. To capitalize on the rebound of the swine fattening prices. So here you can actually see this swine fattening sales of our business was growing quite well between 2014 and 2017. In 2017, we had an oversupply situation in Vietnam because China stopped the movement of swine from Vietnam to China, and all the piggies that were going to the China market were sent back into Vietnam, causing an oversupply within Vietnam, causing prices to drop. And that's why our volumes stagnated to accommodate a drop in demand. But in 2018-19, basically the herds have been replenishing, and we actually had African swine fever in 2019. So that's why we also didn't grow our volumes. But I'll come back to tell you where the demand-supply dynamics in Vietnam are today. But hopefully that gives you a sense of how we've grown our businesses, both the feed business as well as businesses outside of Indonesia. Now, our second strategy is to diversify across 5 proteins and 5 countries. Why is that an important strategy? I think diversification is important because we work and operate in an agri arena, right? And agribusiness is subject to a lot of demand and supply cycles. So you actually get different proteins being affected in different countries. But by having a diversified portfolio of proteins and countries with uncorrelated revenue and profit streams, what we are trying to do is actually to provide some stability of income across Japfa Limited when you look at it as a total group. So that's what diversification means. And our strategic initiatives to diversify across geographies, I think you can see some of the stats there that our total group assets have increased, our total group revenue has increased. We also diversified across different proteins. So swine has tripled its fattening volumes in 2014 to 65,000 tons in 2019. And I think by growing the swine business and together with the poultry business in Vietnam, today our Vietnam business is become one of our 3 key business pillars. So our 3 key business pillars are identified as poultry in Indonesia, swine in Vietnam, and milk in China. So it's different proteins, different countries. And we call those 3 business pillars what drives essentially the business today. Now, we are hoping that one day we'll add a 4th business pillar, which could be aquaculture in Indonesia, for example. But today there are 3 business pillars, and we are looking to actually try and build each business pillar so that they become a billion-dollar business. So to mitigate agribusiness cyclicality, I think, as I said, cyclicality is driven by factors largely beyond our control. And we've had a couple of down cycles in Indonesia in 2014-15, and in Vietnam in 2017. But our EBITDA for Japfa Limited has always remained above 265 million. So really, we go through these major down cycles. People worry about our business in Indonesia. They worry about the impact of the losses in Vietnam. But really, as a group, we never delivered less than 265 million over the last 5-6 years. So we have strength in diversification, if I can put it that way. And so, yeah, I won't labor over this. This also talks about diversification and the down cycles I talked about, and the fact that our EBITDAs are pretty stable and pretty strong, albeit that we operate in a very cyclical and sometimes price volatile business. But really, inherently, because of our diversification, we are able to at least maintain good EBITDA and pretty stable operating profit margin, which you can tell from the bold line here, versus all the profit margins from the other places that can go all over the shop like spaghetti. Okay, the last strategy is prudent growth. So obviously, we're a company that's looking to grow with consumption growth for proteins in the countries that we operate in. But we make sure that even though we got a strong growth strategy, that we are also prudent at the same time. And the strategic initiatives that reflect this over the last 5 years, basically, we make sure that we maintain a net debt to equity ratio at reasonable levels, and also that our capex rollout remains within the EBITDA generated by the different businesses. Now, we also build a very balanced debt profile. So what does that mean? We look to long-term relationships with a panel of international overlay banks on top of the domestic banks that look after the local banking for our units. We also have bonds. We've issued IDR bonds 3 times in Indonesia, and 2 lots of USD bonds as well. So we diversify our sources of debt funding. We try to uniformly have covenants and debt terms across the group to make sure our process is well managed during the year. And we get good support because we're a growing company, so you need debt funding. We want to grow, and we want to minimize the drain on tapping the equity market or going to shareholders to fund our growth. So we try to fund our growth from EBITDA and from debt as well. And so it's very important for us to grow but maintain a pretty good net debt to equity ratio. And it's that balance, I think, that allows us to make sure that we are prudent in how we operate. This is our capex relative to EBITDA, and you can see that since listing, we've been fairly conservative in making sure that we live within our means in our growth. Now, hopefully I haven't lost most of you, but let me talk about the 3 business segments that matter, right? So number 1 is TBK, and I think given that we're number 2 in Indonesia, we are quite well represented across the whole of Indonesia. Our revenue in US dollar terms in 2019 was about $3 billion in Indonesia, with a profit of 257 million. You can see the bold line on the operating profit margin represents the consolidated profit, but really it's linked to the feed margins, which is the little triangles. And that basically drives profitability or consolidated profitability, and it's really the foundation of the business. While other margins like commercial farms, breeding can go all over the place, but the feed margin is what provides that stability to our business. In terms of animal protein other, so that's animal protein business in the 3 countries, I think Vietnam is the star. You can see that in 2019, out of the 650 million revenue from animal protein other was basically dominated by Vietnam, along with the profit coming from Vietnam. And you can see in 2017, we went through a big serious issue in Vietnam, where we lost money in Vietnam, which actually dragged down our animal protein other numbers. But again, as I said, the diversification meant that other parts of the business actually stepped up to cover that loss. And today with ASF, I said African swine fever affected our business in 2019, but you can see Vietnam is still delivering a solid profit of $32 million, even though you can see that African swine fever has had devastating impact on a lot of pork producers in Asia. Now, let me talk about this African swine fever, right? So the business that we do in swine in Vietnam is very similar to the business in China. And in China, African swine fever started 6 months before Vietnam. So we always look at China as a reference point of what will happen in Vietnam. And it's the same thing. I mean, there are a lot of reports that covered China more than Vietnam. So using the Bloomberg report, for example, that said that about 40% of swine, number of pigs raised in 2020, will drop by 40% compared to the period pre-ASF. I think that's the same impact in Vietnam. So basically, you can estimate that there's a drop of 40% of supply. And then similarly on China, a Rabobank report said to recover back, to restock the whole swine farming sector, it will take 5 years. And that is technically correct as well. I mean, China has accelerated that process, by building a lot of farms, by approving new farms and accelerating that process, but it will take a few years. So what I mean is, when you talk about an animal protein business, you talk about protein like pork, you just can't walk into a factory and just switch on a switch and make more pork, right? You have to actually start breeding it from the grandparent, parent, so each one takes 1 year. So that's how you actually build your swine stocks down, so that you can make more pigs in the end, so you can have more char siu and suyo. So really, it takes time to recover. And that's the message we have, because in Vietnam, African swine fever has affected supply today. And that happened in 2019. So in 2020 is the first year of rebuilding, right? And today we sit at the start of 2021. It's the second year of rebuilding. So really, you can anticipate strong swine prices in Vietnam to last for a while. It's not an overnight thing. There is a huge demand-supply gap of 40%. And when you have that demand-supply gap, which takes time to recover, yes, you will have very strong prices, which we are enjoying at the moment. Now, what we've done also is we have a strategy, as I said, to build from great-grandparent farms. And in 2020, we already started to import great-grandparent breeders from our partner Hypor as part of a 3-year plan to improve our performance and actually widen our genetics and increase our production. But it takes time. So it takes time for us. It takes time for everybody else as well. And it's taking time for China as well. That's why you get these very strong pork prices. So that's one thing to put in your mind, that, hopefully, given statistics, we have some way to go in terms of strong swine prices in Vietnam. In dairy, our dairy business, we own 75% today, because in the middle of last year, we actually sold 25% of our China dairy business to Meiji. And in that, you can see our split of our dairy business, where we've got about 80,000 dairy cattle in China and about 15,000 in Indonesia. So the China business is much bigger. The difference is, in China, we sell raw milk. In Southeast Asia, we sell a branded milk product, basically, So there's very big difference. In Southeast Asia, it's a full-on vertically integrated down to a downstream branded product. We don't sell raw milk in Indonesia. But in China, it's the reverse. So if you look at our yields, and I said that we have a continuous improvement in yields, but this is a Rabobank chart that was issued in 2016. We can't get a newer chart than this, but because of the number of dairy farming companies, China dairy farming companies that are listed on the Hong Kong Stock Exchange, which is light blue bars, we are able to actually compare milk yields between different companies, because that information is released by listed companies. And of course, our dairy business in China with 37 kgs back in 2016 is right on the left-hand bar. So we proudly say that our dairy business, our dairy farming business in China has the best milk yields. And that has continued until today. Nobody's beaten us. And I remember when I did the IPO roadshow to Hong Kong, and the Hong Kong investors and analysts and fund investors were very familiar with the dairy companies listed there. And they just couldn't believe we had the best yields. They just really couldn't believe that, you know, a company listed in Singapore, Heritage in Indonesia is the best yields in China. And till today, we hold at number one. Now, the other thing to look at in this graph is that the red line is the average China yields back in 2016. So in other words, the average in China was to produce 21 kgs of milk per day. And industrialized producers like the light blues, including ourselves, were producing 37. So our productivity is so much more than the average producer in China. So it probably costs the same to feed and look after a cow, maybe in an industrialized manner. It costs a little bit more than a traditional dairy farmer. But the productivity yields are so vastly different that it shows why China has chosen to move towards industrialized farming.
Kevin, do you mind if I kind of step in and ask
anytime, anytime.
Yeah. why are your yields so high in China?
Oh, good. I've got a couple of graphs to answer that question. So, since it's an often asked question, so those graphs are still there. Phew. Okay, let me go to that. So really, I think the first thing is experience. So when we started our first dairy farm, and this was in Indonesia, people thought my founder was actually crazy to try and build a dairy farm in Indonesia, because dairy cattle love cold weather, they hate hot weather. And but he said, one day the Indonesians are going to drink fresh milk and look for good quality fresh milk, which can only come from the farm. So if we've got a farm in Indonesia, we are going to save cost of transport of water, which is basically what fresh milk is. It's very different from powdered milk, which is, you know, powdered milk, you can move a lot of it, you can reconstitute it, but you'll never get that fresh milk taste and the quality of the milk and the nutrition of the milk that you get from fresh milk. So he said, I'm going to build a farm in Indonesia, and that's what he did. He built a 6,000 head farm in Indonesia. And that is the basis of the first farm that launched our Greenfields Milk, right? But in 2004, we were approached by Mr. New, who heard about this crazy person building a farm in Indonesia. And he basically encouraged us to do a joint venture with him to build the first 10,000 head, the biggest farm ever in China, with him as a joint venture. So in 1997, we built the biggest farm ever in Southeast Asia. We went to China and built the biggest farm of 10,000 head with Meng Niu in China. We sold that farm to Meng Niu. But melamine hit in 2008 in China. And melamine is where producers were adding plastic into the milk to increase the protein content so they could sell their milk at a higher price to the milk producers. And that was I don't know whether any of you came across it, but that was a very worrying time for China. So we went in and said, well, you know us, we worked with Mengniu, we built the showcase farm of Mengniu. Mengniu went on to use our farm as a blueprint and basically photocopy it, and that's the basis of China Modern Dairy. But when we went to China, we said we're a foreign company, and we would like to start building farms that are on an industrialized basis, and you can be sure that the quality of our milk will never be tainted or never be questioned, right? And of course, we got a license, but we said, no, we don't want to build one farm, we want to build 5. So we actually did that, building one farm every year in Shandong, and we built that first 5-farm hub as a foreign company. And now, since 2015, when we finished that 5-farm hub, we expanded into Inner Mongolia with 2 10,000 head farms. And this year, I'm building the 3rd, so the 8th farm in China. All of them are 10,000 head. There's a blueprint of how we build a farm. You can walk into farm 4 and then go to farm 5, and you think you are in the same farm. You know where the men's toilets are. So
is there a reason why it's 10,000? Is that the magic number?
For us, it develops into a magic number because once you have a number, what we call a blueprint, right? And for us, that number works because essentially a dairy cow has to go to the milking parlor about 3 times a day to milk. And there's a need to go and get milk because basically her udders are so full. It's like us having to go to the toilet, right? So you need to go. And you actually design the farm so it's very comfortable for our dairy cows. When they need to go, they can just go to the milking parlor. They actually walk there themselves. There's hardly any human interaction except the open and closed gates that determine the direction of how they get to the milking parlor. That's it. They go by themselves. They go get milk almost by themselves, and they walk home. And it's the design allows that kind of thing to happen along with biosecurity. And 10,000 head determines the number of vets that you have, the number of farm managers, the number of feed handlers, the number, etc. Right? So when you have a design that's also fixed exactly, so the assistant manager of farm 5 today, when we build farm 8, he might be promoted to the manager of farm 8. But when he walks into farm 8, he sees farm 5. So he knows the issues, he knows what he needs to fix, and he's got his whole structure of people already set. He knows I need to find one more vet because I had 3 vets over that side. That kind of stuff. And it makes operations easy to replicate. So that means I can roll and grow my business fast without rethinking things. And you think it's a very simple thing, but actually blueprints do work when you want to replicate and grow your business. And once you got the model, you can keep refining it and tweaking it and making it a little bit better all the time.
Right. Okay. So how does that compare to a farm in Indonesia? You talked about tropical weather, and you guys are probably one of the earliest guys to do it, or probably the first in this region. In the tropical region to do this, because like you said, in very hot weather, your yields for hosting cow or these cows that are not naturalized in this tropical weather, the yields are low. So how did you guys actually manage to do it in Indonesia so many years ago?
No, our yields are crap in Indonesia. So our yields are about 26 kgs in Indonesia for the longest time, and then we went to China. And basically, we developed the business or refined it with more farms, so more people, more experience. And the key success factors on this page is forage, farm design, and farm management. So our farm management just got better and better in China. And with that, with the best practices of what happened in China, we brought that best practices back to Indonesia. So we actually parachuted some of our Chinese farm managers back into Indonesia, and they lifted the yields from this static 26 kgs to now what is about 30 kgs in Indonesia, but 30 kgs versus 40 over in China, and that gap will never be closed because of the weather. But just producing milk in Indonesia and being the single largest producer of milk, in quality milk in Indonesia, allows us to actually make a very premium brand like Greenfields, which tastes like the milk that you get in Western countries or in Australia, because we quick pasteurize, we've got the milk ourselves, we don't take anybody else's suspicious looking milk. Every drop of milk in Greenfield comes from our own farm, so we know the traceability and all that, and that's why we can actually produce a very good product.
I mean, while we're on the topic of greenfields, we understand you basically have a really from literally the cow all the way to the end product, which is the end retail product, which is greenfields. Right. I think in December there was a announcement that you guys made about a deal with Greenfields about selling a stake to TPG. Is there a reason? Was the price just too good to ignore? Or?
I think that's basically it in a nutshell. You really summarize things very quickly. But I've got a slide later on to basically explain that in a longer, more rigmarole term. But yeah, I think you got it. That's it. There's some offers which are too good to refuse. So essentially, if you look at our segmental trends for dairy, you can see that from a revenue perspective, and this is relevant to what you just raised as well, Alvin. From a revenue perspective, out of the 470 million, 375 came from China, which is the darker blue, and about 100 million came from the Greenfields operation in Southeast Asia. So you can relatively see we were turning over 100 million in 19. But in terms of operating profit, you can see Greenfields was contributing nothing.
Okay.
All the profit comes from selling raw milk, not from being the #1 brand in Indonesia.
Why is that? I'm just curious. Is it the pricing? Because I think the pricing for per liter milk in Malaysia and Indonesia is about the same. I mean, from last I checked. So.
Okay, the reason is because we are brand building. Wow. So we launched the brand in 2000. So it's only been 20 years of brand building. But essentially, whatever money they make, they pour it back into advertising and promotion, because to make consumer food multiples, we believe you need to hit a certain volume size. And we haven't achieved that size. So we only had one farm. And then about 2-3 years ago in Indonesia, we built the second farm. So we are building up volumes and then building up products, yogurts, etc. Right? So there will come a time when we will hopefully see those consumer food multiples that everybody talks about, because your advertising and promotion will peak, but your profits will keep on going. So you don't need to spend more advertising money because your brand is already good, but your volumes start to go up. And that's where the consumer food multiple comes in. Now, it partly answers your question also, why are we looking to sell 80% of that business at this point, right? It's because I think our core competency is actually in farming, in getting productivity from animals, in actually producing productively with efficiency and effectiveness. That's our core competencies. Downstreaming, yes, we are pretty successful in building this brand over time. But now that we've got a strong brand, maybe we've got volumes coming up, even we need to invest quickly to get volumes up. And then we really need somebody that's an expert in downstreaming to take it to the next level. And, by having TPG that has basically taken 80% of Greenfields, and we hope that with their access to management expertise, with their deep pockets to build another farm and increase the volumes, that we can achieve these consumer food multiples and make a lot of money from the brand in the future. And that's why we retain a 20% stake, just to get that upside potential that we've taken the trouble to build,
Okay. So I mean, had you not brand built, I guess the margins would be better, right? If you take
Correct.
that
Correct.
obligation.
To achieve that, what I call the state of enough spending on advertising promotion, then the rest becomes profit, right? That's when you're king, basically. And I think, hopefully they will have resources that will be able to take us there faster, rather than us doing it, which will take, I would say, a longer time, given the less experience we have in consumer branding, rather than focus on the stronger experience that we have, which is in China. So that's why with the sale of greenfields, also it allows our people, which is a finite resource, to now go back and start making more money in China.
Okay.
And the final, probably one of the last few slides on China, raw milk. Just to give you a sense of raw milk prices, right? Because that determines our profitability in China. So raw milk prices have not been good in China since 2015. So in 2014, they were really good. And in 2015, they started going down, and they've stagnated almost to the first half of 2019. So like 4 or 5 years. And what has happened there is we were building furiously, one farm every year, until we achieved 7 farms. And that was probably the last farm we started building in 2014, 2015. But we stopped building because the raw milk price was not improving, because because of powdered milk substitution in China at the time. Powdered milk prices crashed in 2015, and a lot of producers were substituting fresh milk with powdered milk. That really kept raw milk prices down. And one impact of that is all the dairy farm companies in China stopped building farms, including us. And from this graph, a rubber band graph, I think, or Moody's graph, you can see that the supply of raw milk flattened and even kind of didn't go anywhere from 2016 to 2019. At the same time, in China, the slow capture of milk products and premium milk products and dairy products started to grow very slowly, until the point achieved in 2019, when there was a demand-supply gap. And finally, the producers in the middle of 2019 decided to pay a fair price to the raw milk dairy farms like us. So we started making a lot of money in the middle of 2019. And 2020, that's continued. So you can see our profitability in dairy has been strong over the last couple of years. And hence, that's why we've started to build the next farm, called Farm 8 in Inner Mongolia in 2020. We started that in the middle of 2020 because of very strong raw milk prices. Now, dairy farming is the same as swine. You can't go into a factory and switch on a switch and get milk tomorrow. It's another 3-year wait, right? Firstly, for us, it takes about 1 year to build a dairy farm. And if you're building in Inner Mongolia, you are down to about 9-10 months, because for 2-3 months, it's too cold. Concrete doesn't even set, right? So you essentially have a short period to build a farm. And then you got to, if you didn't have dairy cows, you've got to import your heifers from Australia, New Zealand. You've got to inseminate them, get them pregnant. After 9 months of pregnancy, then only they start milking. So you're talking about a 3-year minimum time frame to actually start milking. And it takes about 1 year before your whole herd milks, right? So the process is very long. And this demand-supply gap and the raw milk prices increasing in 2019 means that, again, we feel the demand supply gap in China is here to stay for a little while, and we will again enjoy strong raw milk prices, we believe, based on this information, for a little while yet. So 2 takeaways, because China dairy is one of my core profit drivers. Swine, Vietnam is one of my core profit drivers. Both have got demand supply dynamics which reflect strong prices in the medium term. Okay, so I think consumer food is a very small segment. As I started off saying, 85% of chicken is sold fresh in Indonesia. So our branding for consumer food products is there, but it's really about 7% of our business. The other 7% is selling raw meat. So it's a very small part of the business, our consumer food. And again, just like our dairy downstreaming, we plow it back into advertising and promotion and brand building exercise. So this is my 9 months results. I've only got 3 pages. Very quickly, I don't want to labor you guys with a lot of financial numbers, but just to tell you where we are at the end of September of 2020, the last release of numbers, right? So our revenue is almost 3 billion for the 9 months. We saw a drop of revenue of 2.5%, driven mainly because of Indonesia. But in terms of profitability, you can see that our profitability is improved for the same 9 months of the previous year. And in terms of EBITDA has gone up by almost 25%. In terms of attributable income, PATMI, profit after tax without minority interest. So attributable income to Japfa Limited, because I only own 52% of the Indonesian sub and 75% of dairy. My PATMI, so what comes to me at Japfa Limited is about 130 million for the 9 months. And core PATMI without Forex is without the measure of bio-asset gains and losses from valuations, and also without Forex. So just to give you a reference of what's under our control. So we give 2 measures of attributable income. So you can look at either, but core PATMI without Forex, 140 million, which is almost up 200 times from the same 3 months last year. So what is really the 9 months numbers? I think I can say out of the 3 strong profit drivers, there's strong results from swine in Vietnam, strong results from dairy raw milk in China, but a weak performance of PT Japfa TBK. And that's basically because of COVID. And I'll come to that. So really, COVID is impacting Indonesia. And that's really lowered the demand for poultry products because of the drop in GDP per capita of the low income band. And that's impacted day-old chicken broiler prices, bringing down our profitability in Indonesia. But even with that, we're having strong profit growth compared to last year, considering 2020 is COVID. And we also run this measure called rolling core PATMI without Forex on a rolling 4Q basis. So hopefully you understand this graph. And the shades are the different segments. So the blue is the dairy. You've got animal protein, others, yellow, and the red or orange is PT Japfa TBK. And if you just look at the September 2020, at 212.9 core PATMI of the Forex, it's actually the all-time high since we listed.
Mm-hmm.
And this is during COVID. And so you can see the dairy side is firing because of strong raw milk prices. So it's delivering 96 million. The animal protein side is crazy, delivering just because of Vietnam pork prices, primarily 93 million. What's suffering is TBK, PT Japfa TBK. But even then, without TBK or offsetting TBK, I'm still recording an all-time high. My CAPEX, very quickly. Typically, I would spend, $200 to $300 million if you look back in 2018-19. So in 19 as a reflection, I spent 216 million in TBK in Indonesia, 36 million in the whole of animal protein, other, and 22 million in dairy. In 2020, you can see a big change in Indonesia. what we were budgeting to spend well in excess of 2019 for the Indonesian capex for 2020, and that's been pulled back dramatically because as soon as COVID hit and we felt the demand drop in Indonesia, we pulled back on all non-essential capex growth, and that is an interesting point because I think in animal protein, other and especially in poultry, chicken, it's very easy to quickly readjust your capex to suit the demand dynamics in the country. And what does that mean? That means if I'm going to see a drop in my EBITDA in Indonesia, I can make sure that I drop my capex not instantaneously, but very soon thereafter. So I never overspend what I don't have. And so you can live within your means, because in animal protein, we tend to build small boats and not big ships. So it allows you to do that. And you can see that happening as a prudent growth strategy. You can see it in real terms, in terms of how we've delivered our capex or spent our capex in 2020. And I think, for animal protein, other, given the opportunities for swine, you will see that capex for APO Vietnam grow quite dramatically going forward. And of course, in dairy China, I just began to build my 8th dairy farm somewhere in mid of 2020. So one dairy farm in China cost me about 90 million US. So you will actually see that capex go up as well. So that's really some thoughts about where it's going to go, where money is going to be spent. I think capex will be frozen in Indonesia until we can see light at the end of the tunnel in terms of COVID and its impact on demand. So talking about that, we go into a COVID update, and I think we try to break the COVID impact on Japfa into 3 main areas: operations, supply chain, and demand, right? So when you look at impact on operations and supply chain, I think in many of the countries we operate in, we supply about 20 to 25% of some of the staple animal protein foods in any of those countries. And so we play an essential role in staples. And what does that mean? It means that government steps up to make sure that essential service is not disrupted. So in other words, our supply chains, logistics, almost no disruption in all the countries we operate in. So that's supply side. Day-to-day operations, also we run farms outside in rural areas. We've already got biosecurity in our farms to protect the animals. Today they protect the workers as well. So the incidence is controlled, at least in our operations. So where has COVID impacted Japfa? It's in demand. So in demand, we talk about our 3 main profit areas again. So the first one, poultry Indonesia. I think the first hint of COVID was felt during Ramadan, where typically we have a high demand for chicken at the time. But in April 2020, we saw broiler prices and day-old chick prices crash. And this was the oversupply. In other words, the whole industry ramped up supply, expecting the best demand time. But at the same time, COVID hit and dropped demand. So you had this really wide demand-supply gap, and prices basically crashed. They rebounded back in May. Was only okay in second Q. And I would say that prices remain volatile in Indonesia. And that's because the supply needs to readjust itself back to the new level of demand. And it takes time for that to happen. And I think in Indonesia in August, we've seen the new Director General come into Indonesia for the Ministry of Agriculture. And he's been doing some great things in trying to manage the supply of day-old chicks, which in effect helps to stabilize the prices of both day-old chicks and broilers. So this Director General is very effective. He's got very strong policies to reduce supply, which includes culling and all that. And that's really helped the prices stabilize in towards the third quarter of 2020. And if you look at the broiler and day-old chick prices in the fourth quarter of 2020, they were fairly stable as well. So I would say there is potential for prices to get better in Indonesia. However, the effects of COVID are still unfolding in Indonesia. So that's still the uncertainty, and it's very hard for us to actually try and determine what the outlook of Indonesia is. And so I think when you talk about COVID impact on demand for our other profit drivers like dairy China and swine Vietnam, hopefully I've already explained to you that the demand-supply gap should not cause any prices to remain strong, and COVID should not cause a major impact, because I think COVID is largely under control in those two countries. Okay, so some latest developments very quickly. In April of 2020, we actually sold 25% of our dairy farming operations in China to Meiji for 254 million. That puts an implied value of just our China business at $1 billion, right? Just to set the frame.
$1 billion US, right?
Yeah, correct. So transaction was completed. We were very happy because the transaction started pre-COVID. COVID happened. You would imagine that if you've got a buyer for 25% of their business and the guy has to come up with hard cash of $253 million, it's a big ask, when COVID hits and cash is king and, that kind of thing. But the deal closed, and we were able to take in $253 million and pay down our debt, actually, by that amount. So deleveraging the company during a COVID time. So we are more than happy with that transaction. That transaction was able to close. And from there we've launched into building our Farm 8, as I said, our next expansion to improve and increase our volumes in China. But this is a transaction Alvin also brought up, that just recently in December, we entered into a sale and purchase agreement for the sale of 80% of our branded business. So the other part of our dairy business. And the pricing for this was that the price paid by TPG implies equity valuation of Greenfields Dairy of $295 million. So really, I guess what I'm saying is that if this Greenfields or our Southeast Asia business is valued at almost $300 million, our China business valued at $1 billion, our dairy valuation itself is $1.3 billion based on transactions, of real transactions with external companies, right? And our total valuation for the whole group pre these sales was 1.3 billion, not far from that. So in other words, I'm saying that the value that is in some parts of our business, were not reflected in the share price of our listed counter. And
why do you think that?
We're undervalued, but this is a testimony from externals that we have been undervalued. Sorry, Alvin, what were you saying?
Yeah, so why do you think the market? I mean, you guys are which is weird. So in Malaysia, when we see an integrated a player like you guys, you're looking at least 30 times PE. Why do you think that you guys are trading at a single-digit PE? If you were to guess.
If I was to guess, and obviously we've thought very deeply about this, but you can only make that. So the first thing is there are no farms in Singapore, right? So people do not understand farming, and they don't understand the relevance of farming. And that's number one. Number two, I think there's volatility in parts of our business. So you actually get like you saw some graphs earlier, Vietnam goes into a loss for the whole of 2017, for example, right? Our whole animal protein, that scares people, that, wow, you can actually go into a loss for one of your major profit drivers, right? TBK, PT Japfa TBK, you can see from the rolling 4Q I showed you also, the TBK portion is so small, of what's contributing to our total attributable income. So small this year, but it's just supported by the two other things. So there is a lot of fluctuations given that we work in agribusiness, given we can't control supply and demand, and we can't control external factors like external economics, etc. But, I think that scares people. So that's the second thing. It's the non-linear, very stable profitability. But that's why we try to message that even in my worst years, even when you think the world is crashing in Indonesia and TBK or in Vietnam, actually my EBITDA, I'm still generating $260 million. I have a comfort level that you should start to understand, you know what I mean? And once you understand that feed is the stable pillar of profitability, that in Japfa Limited, given our diversification of countries and proteins, you understand what we're trying to do also, and you understand the prudent background of what we have, you can take comfort that we can ride the cycles. And when we ride the cycles, we usually emerge stronger. That's why we keep consolidating market share in swine in Vietnam, because the smaller backyards with the lesser productivity, with higher cost of production, when things get tough, they suffer more. And so our mandate is actually to be one of the lowest cost and most efficient producers of protein in the country we make that protein. So that means I do not build the business to be export driven. I build the business so that I make chicken in Myanmar for Myanmarese. Now, if something happens in Myanmar that makes the whole business tough for everybody, hopefully at the end of it, I'm going to emerge stronger because I have built the business on an industrialized model. So making sure that its performance, there's proper strategies, there's proper biosecurity. And hence you can see that already happening in Vietnam. We're going to emerge with a much bigger market share than our competitors because we believe we were the least hit by the ASF situation in Vietnam. So once people have a belief of that, I think it's very easy to invest in our stocks. I think if you're interested in long, I think hopefully as more people understand our business and understand our long-term strategy, there will be positive growth in our valuations and bringing our market values or our stock price closer reflection of what we believe is the intrinsic value of the company. So that's one thing. But if you're also somebody that likes to go in and out of the market, I mean, if you look at some of our stock prices in the past, and including in Indonesia, where I'm also listed at PT Japfa TBK, you can see that in down cycles like now, the stock prices, people sell, right? And actually you should be buying when it's down if you believe that the business is basically solid in the long term and you're willing to hold long, and then you sell when you think it's too high. I don't care. I mean, so long as volumes, I'm more than happy that people have an interest and that, you understand what we are trying to do is to build a long-term business and to grow the business into the future.
Yeah. So we have a. Do you mind if we go to some of the questions from the audience?
Definitely. There you go.
So we have one from Bradley here. He says, which one of your pillars, right, of your segments actually has the highest profit margin? Is it the dairy? Is it the poultry, or is it the feed?
Okay, that's a very broad question, Bradley. Thanks for the question. But basically, feed. If you look at, say, let's talk about our poultry business in Indonesia. My operating profit feed margin is about 10 to 11%. So that's not a lot. That's before financing, right?
Yeah.
And that profit margin, I can tell you, is not going to grow. So the reasons for that is basically it's a tight margin. And remember, it's a pass on, right? But the feed business is not super technical. I mean, there is some technicals to it. But the feed business, one of the key success factors is size. So economies of scale, because you can buy a whole shipment of soybean meal, for example, without having to share it, pay a middleman. You can actually have geographical diversification within Indonesia so that you can put your corn drying stations and feed mills close to the farmers, as well as close to the corn suppliers to get your corn during harvest season. All that helps you reduce your cost of goods sold. So when I'm having a 10 to 11% operating profit margin, it means my smaller competitors in Indonesia would be probably running a single-digit operating profit margin. In other words, it's very fine margin to feed. But at the same time, you always make money. You never sell feed unless you make a margin. You are never forced into the situation to sell your product because the raw materials last a long time and have got, commodity value. So feed is a great business. I mean, then you do day-old chicks, which is breeding, farming business, right? We basically do the day-old chick business so that we can sell more feed. Because a farmer wants a total solution of, you go to a supplier, you get the day-old chick, you get the feed. The supplier says, hey, you use my day-old chick, you use my premium quality feed. In 32 days' time, you're actually going to get a market-sized chicken of 1.6 to 1.7 kgs, right? And a farmer will actually, become your customer on that premise, right? And really, in the end, you do day-old chick, which has got volatile prices and all kinds of fluctuations depending on demand and supply in the broader market. But it comes down to actually making money at the feed level. And then when you talk about commercial farming, I make 2 to 3%, very small margin for poultry farmers. Why is that a small margin? It's because every man and his dog can do commercial farming. It's not a very highly technical business. And actually we do that business because if we know how to do breeding farms, commercial farming becomes a given, right? And also it connects our vertically integrated chain, so that when I start producing consumer food products, when I start producing chicken for McDonald's in Indonesia or whatever, I have that ability for traceability and food safety all the way back to the feed mill through the commercial farms. So I can be sure that the product that I sell under my brands have got that full control of product quality. So that's why we do commercial farming. So when you talk about margins in animal protein, it's all very tight margins. But I think the interesting thing about tight margins and why feed margins are so tight is a barrier to entry.
What about dairy farming in China?
Dairy farming in China, you are driven by raw milk demand, supply prices in China, right? So that is broadly the whole Chinese market you're talking about, right? But having said that, I think when we first went to China, and you look at the Chinese government, they're very, very focused on how they see development of the agrarian sector. So really, I think the Chinese government has been had the foresight to say it's no use trying to promote inefficient farming in China. If industrialized producers are going to come here and do almost double yields, it's better for those guys to take over the business. The original 5-cow dairy farmer can either go work for a dairy farm, right, or do something else. But it also means that they reduce the labor from being labor intensive in agrarian sector in China. They release some of that labor into the cities, where today you can see with the prosperity that labor has been more computer savvy, more moving towards technology, and actually it's been shifted towards what I call more productive industries that are driving the growth in China. So when you talk about margins in dairy, it is a mix of the raw milk price and your productivity. So the higher yields you have for the same cost of running that cow, if you can produce 39 kgs versus China Modern Dairy that does 36 kgs, you've got a 3 kg advantage of profit. So that goes straight to the bottom line in the end.
So what would you say the margins are like for, say, dairy, and like just a ballpark?
It's very hard because margins in dairy have shifted over time. But if you look at my 2019 numbers for the whole of dairy, I think EBITDA margins are like 26% versus 11% in animal protein generally. So much higher in dairy. So yeah, hopefully that gives you a reference. Dairy margins are high, but I think for animal protein, it is most, how would I say, there's strong potential for growth on the backbone of the business that we know very well already. That's how we frame it. And it's the farming side that we know very well. And we've got so much more potential, in terms of what I said, the 11 kgs per person per year in Indonesia versus 40 plus in Malaysia. The China consumption of milk is and growth potential there is astronomical. In China also, you see the industrialized producers are slowly being consolidated by the bigger producers like Mengniu and Yili, right? So they're buying all the dairy farming companies or taking ownership stakes. There's very few independent dairy companies left in China. And I think we are emerging as the largest independent dairy company. What does that mean? That means outside the Mengniu and Yilis of this world in operating in China, you get somebody like Meiji. Their Meiji is like the number one brand in many milk dairy categories in Japan. And if you look at their worldwide expansion, they list China as their priority. And they've been in China for a while. And they have a pretty good branded business in China, growing quite robustly. And they used to buy milk from a number of sources, including from our dairy farm. Now, they slowly realized that one day they have aspirations to grow in China, but they might not be able to get raw milk. Hence, they're willing to take a stake in a dairy farm company like us, 25% stake, so that they can be assured that if they did need 25% of our milk production, sure, we'll give it to our shareholder, right? And that's essentially the market in China. So I think we've got a good market position because there's a lot more Meijis in China. There's a lot of foreign companies that actually produce quite substantial volumes of milk in China that are slowly harder and harder, finding it difficult to get milk. So I think that's driving the potential for good margins or good prices, negotiation, good negotiation level, going forward for our raw milk prices in China. So that's our long term or our strategy in China.
I mean, we're actually quite in terms of dairy supply in Malaysia. It's almost non-existent, right? I think there's a question here: are there plans to move into Malaysia?
We actually do not have plans to move into Malaysia. I think we look at Malaysia as almost semi-developed, and number one. Number two, in terms of poultry, you already have achieved 47 kg, so there's no potential for growth in consumption. So in other words, I have to fight and price war your existing players. So it's not an area that we are interested to move into. In terms of dairy, we have a dairy team that in the past has focused on China and then Indonesia. I think more and more we are going to focus on the growth in China, given the short supply. But in the longer term, of course, we operate in 5 countries already, and there are opportunities in dairy in some of the other 5 countries that we're already operating in. So it's unlikely we'll come to a new country in Malaysia where we don't have a presence. I mean, it's very likely, for example, we can go to India where there's huge dairy consumption, but more old style, more, especially in the north part of India, more home delivery and bottles still. And that is opportunity kind of written all over it for an industrialized player to be there. But, we don't have the human resources to actually do that. So I think over time, if you look at the matrix of 5 countries and 5 proteins, I think we do have some opportunities within that matrix to already grow. And, we're also dipping our toe in Bangladesh, for example, just to see how that goes in terms of animal protein. So, yeah.
Thanks. So I've got another kind of question here. We talked about dairy in China. So I think you kind of answered it, but are there actually any plans? Because you guys did sell greenfields, and you're saying that, we just want to focus on farming, and be the best at it. But is there a plan to build a brand in China and do the whole thing that you guys did with greenfields?
It's a humbling experience to operate in China, actually. So you think you have 8 dairy farms and 80,000 heads of cattle, but actually you're pretty small in the landscape of China because everything is so huge there. So yes, even though we supply our main customers today in China for raw milk, like Yili and Mengniu, we already have launched a local brand. It's not greenfields. We tried greenfields, but it didn't work as a branding strategy in China. So there's some other name. I think it's from Austasia Farms or something like that in Chinese, right? So we've started that. It's in a very small way. We are looking for premium branding. It will probably take years before it becomes anything. So we don't even reflect it anywhere. So it's more a trial and error thing. It'll just take years. There are also entrenched players there that will just smash you. So you just stay on the fringes in China, I think.
Yeah, I mean, like Yili, those guys are big, right?
Huge,
right? Yeah,
unimaginably huge. Yep.
So we have a question here. Is there a reason why you build it in Inner Mongolia? Vis-a-vis other or any other locations? Is it because of the climate?
You're 100% correct. So basically, there's a band of where dairy cows are most comfortable with in China. The bottom part of the band is just about Shandong, right? And that's where we built our 5 dairy farms. But what was strategic about Shandong was it is between Beijing and Shanghai. And Shandong itself is a very fertile area with a lot of farming and crops. And actually, the byproducts of a lot of crops can be used as dairy feed, right? So it's a good place to be in Shandong. And I think we were lucky in 2008 to start our presence in China in Shandong, because today to find big blocks of land for our dairy farm is getting almost very, very difficult in Shandong, right? So one is scarcity of land because it's more and more developed over the last 10, 15 years, the whole Shandong region. So when you look at the band of comfortable temperature, the cows, Shandong represents the bottom part of where cows are comfortable, right? Inner Mongolia, which is a province of China, so I'm not talking about Mongolia, Ulaanbaatar, right? So this is Inner Mongolia, which is a suburb of China, I guess. That part of Inner Mongolia where we've got our farms is probably the limit, not for dairy cows, but for humans. Dairy cows like it even colder, right? But when it gets even colder, it's terrible for your workers because they're suffering in super cold weather for too long, number one. Number two, you get all these farm issues like the water freezes in all the pipes. So you must have change all your piping system, your drainage, your waste system, because the ice on the ground. So it becomes not manageable anymore. So by that limit, you go around and you try to find big lots of land. And what we do is, as the strategy from my CEO and founder, when we went to Shandong, we went to the provincial people and said, I don't want to build one, I want to build 5. And most people say, you sure? Yeah, I want to build 5. So as soon as you finish the first one and you're building the second, everybody gets excited because provinces are graded on how they build businesses and promote employment in China, right? So when you go in with big plans, you get a lot of support, and that allows us to get big lots of land. So the dairy farm only occupies a small portion. We actually get around our dairy farm a big portion of arable land where we grow the crops for the dairy farm. And I think from observation, I say this, that in Shandong, we were given land that was not super fertile. And by having a dairy farm there, over the years, all the manure is actually going to go into the land to grow the crops. And over time, that land becomes fertile. So the Chinese government cleverly gives you kind of crappy land. And by having a dairy farm, in 10, 20, 30 years' time, you'll actually have very, very good farming land. So yeah, we kind of run out of land potential in Shandong. So we chose the next areas in Mongolia, and immediately we said to the provinces there, provincial governors or whatever, yes, we have a plan to build a few farms here. We'll start with 1, 2, now we're in the 3rd. And that incentivizes those government agencies to give us the big blocks of land that we want, and which is important for us because it keeps biosecurity at another level as well. So you don't have dairy farmers coming close to you. You can make sure your biosecurity is top class in your farms.
Okay, so we have like a couple of questions, if you don't mind. We've got quite a few
questions. If people are still awake and listening, I'm here, man.
Okay. So there's a question here. What is your take on food supply chain in the COVID era or post-COVID era, where food manufacturers become increasingly decentralized as a result of food security, which is, you guys are kind of saying that you are actually isolated in each country because you're there to supply, not to export, but local, right?
Correct. I mean, that's an excellent question, Alexander. Really, what we are saying is this new world reflection about globalization and towards localization, or whatever the term is actually playing into our hands, because we've always built proteins for the domestic market. And today, I think it's brought home the importance of actually having a domestic supply for your staple products. So that includes the basic proteins like chicken and pork, for countries that have that as their staple menu item. It's probably better that you are independent in those areas for food security going forward, in case, issues about supply chain disruption and demand and supply and costs and food security come into play. So I think this global trend post Trump and post COVID, I think is actually probably going to help us grow our business as well.
So do you think there's a big push for governments to really push for self sufficiency for a lot of these staples that you guys are in?
I think so, Alvin. I mean, if I was running government, I'll make sure that, for example, I have enough local chicken production, because in a war and, I can't get my chicken from anybody else, I can at least feed my people, because the only hungry people are the first ones that are going to kick out incumbent government. So you just want to make sure you feed people, give them the basic necessities, and that's how you govern properly. So actually, I would say it is a good strategy if I was running a government to make sure my staples are actually local.
Oh, Okay. Okay, so we have this next question here. So it's a long question, and I thought it'll be quite interesting one. So unpopular question, and maybe a little bit far fetched. Do you see the growing middle class being concerned about industrial farming? And that's because that's the core of Japfa's pillars, right? Because they're a bit more, conscious millennials. What you know?
Understand.
What are your thoughts?
So, yeah, no, it's not a far-fetched question actually, and it's definitely not an unpopular question, Bradley. Actually, you talk about things like Beyond Meat, etc., which is substitutions for protein. I would put it at this point, it is a first world issue. And a company like ours, Japfa, we are still dealing with third world issues. So the level of stunting in Indonesia and the level of malnutrition is huge. And COVID and the drop in GDP per capita for the low income band in Indonesia is quite bad. And what does that mean? That means my main issue today is to actually try to get food out to as many people that are lacking food and to keep the cost down. And hence, I would say that the solutions that we provide will be with this emerging economies for a while yet. So I don't see any threat of first world issues coming to affect our business maybe in the next 20 to 30 years. I mean, once we can feed everybody and then everybody's happy and, they're willing to pay more for something that's home lab grown or, without the issues of a planet. And actually, if you look at planet issues, maybe my dairy cows are bad for greenhouse gases, right? I admit that my beef business is bad for greenhouse gases. We can do as much as we can to mitigate that, biodigesters in China. But in the end, if you look at poultry, it's actually quite okay. Poultry is it doesn't need to destroy forests. It's a very low cost option. The distribution is very great. You can go deep into rural parts of Indonesia with a fresh product. So I think I can't see that the disruption to the poultry and maybe even to pork is going to be in any scale in emerging Asia for the next 20, 30 years. I mean, maybe dairy and beef, yes, but unlikely for the others.
Okay. Okay. So I have another question here on dairy farming, on the dairy industry. With China and Australia now in a row, they're not good friends anymore. Best mates, right? Do you see them doing maybe some sort of quota or some sort of embargo on, because Australia obviously exports a lot of milk, and to China as well. Do you see this happening?
I think China is very careful to select the products that it can do without from Australia, but at the same time, the products that it needs, it will continue, right? So I say, yeah. If there's a shortage of fresh milk in China today, I don't think they would shortchange the Chinese people by causing disruption to that supply chain from Australia, right? So they're very selective. I think it's a very political move more than anything else. But at the same time, they'll make sure that people are well looked after. What could impact my business is that they don't allow the heifers to be exported to China for the growth of the domestic dairy business in China, like us. So my farm, I'm fortunate because I have 7 farms already in China, and each farm produces more heifers than it can regenerate into the business. So I have excess heifers, and those excess heifers are going to populate my farm 8, so that I hardly need to import any heifers from Australia. to grow my business. Whereas another guy who's also trying to grow dairy farms in China might have that problem. So, hey, that's an advantage for me.
So do you sell those heifers, those excess heifers that you do have?
No, we don't.
Oh,
Our
okay.
heifers are okay. So I go back to my basketball analogy. When you actually buy heifers from Australia, you must realize that you are buying it from a dairy farmer, right, in Australia, and his business is to be a dairy farmer to make milk. So when you go and buy heifers from him to import to China, he will say, "Oh, you want to buy heifers? Okay, go down to the back paddock because it's the crappiest cows he's got." He's not going to sell you the best cows. He's going to sell you his rubbish, right? So you take that to China, and you must realize that you are getting the second grade. So what we do is we buy the best bull semen out of the US, and we improve the next generation of heifers that we grow, and we improve the next generation. So since we've been there doing this for about 7, 8, 10 years, our heifers are already very superior. This is genetic superiority, building that basketball 6'5", slowly improving. And we don't sell that, of course. What we do is we try to improve the bell curve. So in dairy farm, like everywhere else, you've got a bell curve of lower productive animals, average, high productive animals. So that you actually try to shift that whole bell curve by removing the low productivity cows and replacing them with the new heifers. This is when you have excess heifers, but it's yep. I mean, we use genomics, we use everything in our company. So we use technology basically.
So how long would say a heifer? What is the lifetime of productivity?
About five milking average.
5 to 6 years, once a year, right?
Well, it takes about 2 years before I think they get to heifers. So that means it's a teenage cow where they can actually start to get pregnant, and then one pregnant. So maybe 5, 8 years altogether. So first 2, 3 years they are unproductive teenagers, babies growing up, and then they get pregnant and they start milking, and they probably can do that 5 times, 6 times if you're lucky. So as soon as we artificially inseminate, and you might not get pregnant the first time, but if you don't get pregnant the second time we artificially inseminate,
okay,
bye.
So what happens to these cows? I mean, is it sold as beef after that, or?
I think if it's say five milking, there's still, if you are willing to continue that as your dairy cow, where on our bell curve, it starts harder to get her pregnant, which means you spend a lot more cost for artificial insemination. And as I said, we do it professionally, but if you sell it to a farmer, it's got some value, a smaller dairy farmer, he's not so worried about artificial insemination. He might get the local bull to come along and try to get her pregnant and then try to get her milking again. Sure, there's still a few more cycles left, but for us it's not productive. It's not economically worth it to actually keep managing that old cow. So yeah, I believe they are sold, right, and used as dairy cows for a little while.
Okay. I think maybe so this, I guess there are a lot of thank yous for spending the time with us. We're coming close to probably 2.5 hours here, but what are your thoughts on what Balagna did with in Qatar after the 2017 blockade that they had, and they flew in cows from planes and kind of set that up, and and they basically had a milk industry in the desert, right? What are your thoughts
about? One of the best yielding dairy farms is actually in Israel. And so it means that if you actually do things in a very structured manner, an industrialized approach, you can actually build dairy farms in areas that are not really conducive. But obviously, I'm sure there's air conditioning or cooling systems that, unless you had deep pockets and a lot of money, it would not be economically viable in many other countries. But the cost of actually shipping fresh milk from, say, a Western country to the Middle East versus the extra cost of actually building a farm in the Middle East makes that a viable thing. But I wouldn't put it as the first business you want to rush out and do. You know what I mean? Much easier ways to build dairy farms. But yes, I've heard success stories in Israel for dairy farms.
Yeah, they are the highest yield dairy farms in the world. Yeah,
That's right. But we'll get there. Alvin. I think we have aspirations to be top 3 in terms of yields, but in a finite number of years, maybe 5 years or whatever. That's what our dairy division is trying to head towards.
Okay, look, I think Kevin and Eileen and Elvina, who's actually tuned in as well. Unfortunately, we couldn't get your cams on for some reason, so we only see like a blank thing here. But Kevin, thank you very much for being here and spending time with us. I'm sure every one of you guys here who logged on and still stayed on after almost 2 hours now.
Thank you.
I actually got to understand Japfa a lot better, and of course, then you guys can understand the business or the how and the why, before you do any sort of investment, and that's the whole idea here. So what I'll just quickly do before I wrap up is just a quick reminder that for those of you who have not set up your SGX account yet, and you have yet to start trading, there's plenty of resources that you actually can get from the SGX website as well. And also, I've actually summarized all the list of brokers where you guys could get access. Just remember, actually, Japfa is listed in Singapore and also the Indonesian Stock Exchange as well. So the one that's listed on the IDX, I understand, is Sharia compliant, so it excludes that swine portion. Am I right, Kevin?
Yeah. Correct. So in Indonesia, we don't have swine at all. So
yeah. So that's Sharia compliant for Muslim viewers out there, and of course this is the whole summary. So if you can also deal with your local broker or go online to access some of these companies that are outside of Malaysia. Otherwise, I think let me see. I think that's it. Yeah, that's all I have in my slides. Thank you very much. Tomorrow night we will be back. We have another very interesting segment. We're gonna do a roundup of COVID players, right? Anyone that's somewhat related or made an announcement or diversification plan to COVID. We're gonna talk about the whole COVID ecosystem tomorrow night at 8 o'clock. So once again, thank you everyone here for being here, and goodbye and good night.
Thank you.
Thank you very much. Thank you so much, guys.
Bye.
Bye.